Welcome to the Three Edge Weekly Review for the week of March 21st. I'm Fritz Folts, the Chief Investment Strategist here at Three Edge, and joining me here today once again is Steve Cucchiaro, CEO and Chief Investment Officer here at Three Edge Asset Management. Today, Steve and I will be discussing how the highest inflation readings in decades are inflicting real pain on the bond markets, and the risk of stagflation could be a threat to the corporate credit markets. And we'll discuss what the bond market may be telling us about the future direction of the global economy and the global capital markets. Beginning this month, the Fed has begun to raise short-term interest rates, and Fed Chair Powell has been quite explicit about his belief that the Fed may need to continue to raise interest rates throughout 2022. And he also indicated that the Fed may need to raise rates by more than the 25 basis points at a time if inflation remains elevated. And so, with inflation at four-decade highs and war still raging in Ukraine, and with some suggesting that the price of oil could reach as high as $200 a barrel, the risk of stagflation, an environment of high levels of inflation and slowing economic growth, remain a concern. But meanwhile, even with interest rates and bond yields rising over the past 2 weeks, equity markets have actually rallied, even though year to date, both the S&P and the Nasdaq are still in negative territory. So let me bring Steve in here. And Steve, thus far in 2022, the bond market really has suffered material declines. And so, what might rising interest rates and rising bond yields be telling us as investors? Is the bond market signaling that they're convinced that the Federal Reserve now is serious and they're going to raise interest rates and try to actually combat inflation, even if that costs an economic slowdown? How should we interpret the sell-off in the bond market thus far in 2022?
Well, Fritz, I do think the bond market is giving a very strong signal, and it's reacting to the fact that the Fed has been so late in responding to inflation, perhaps later than ever before, which is saying something because they're typically late.
Right.
Uh, and not just the Fed, but other central banks too, because often the other central banks follow the Fed. That we now have a situation where the bond market is very concerned that being so far behind the inflation rise, the Fed and other central banks are now going to have to do double duty and really raise rates a lot more quickly than would have been ideal had they acted sooner. And so this is setting interest rates up very strongly in anticipation of this move. And of course, when interest rates go up, the principal value bonds go down.
Right.
And this has been one of the most serious corrections in the global bond market in history. And you can see how volatile the bonds have been in the accompanying chart. It's been very extreme. The other thing I should point out is that short-term bonds are rising, even
Mm.
short-term bond yields are rising even faster than long-term bond yields. And what that does is it flattens the yield curve, meaning the difference between long and short. And that is an early warning signal. Hasn't inverted yet, but it's an early warning signal that we should all be watching very carefully to see if it's going to signal a recession down the road. And if that's the case, then we could expect to see pain in the corporate bond market because not only are interest rates rising and principal values falling in the corporate bonds, but the spread between corporate bonds and treasury bonds will most likely widen if there's a fear that the economy is going to slow down.
So that could be serious down the road. But here, interestingly enough, we have the war in Ukraine raging on. We have bond yields continuing to move higher, but yet over the past couple of weeks, the equity markets have actually rallied. And although the major indices, including the S&P, remain lower year to date, but how should we think about this recent rally in equities? Are we seeing the return of the equity bull market, or is this more likely to turn out to be a bear market rally for equities?
Well, if you think about it, Fritz, over the last decade, we've had a generation of investors that have learned to always buy the dip. And this habit is hard to break because it's been rewarding for so long and it's still going on. I've been reading recently that a lot of the dip buying that we're seeing is coming from the same amateur retail investor group that bought the meme stocks last year, which were stocks that went way up in price far in advance of any fundamentals. Also, if an investor thinks of their universe of investing as either stocks or bonds, and now they're pulling out of the bond market because the bond market's doing so poorly, a lot of those funds have been going back into the stock market, and running out of bonds back into stocks. And there's also this popular narrative going around advising people to buy stocks as an inflation hedge,
Mm.
since inflation is going up. Now, the 1970s disproved that idea. We
Right.
had a lot of inflation, stocks get hammered, but not too many investors these days remember that far back. Another point, earnings multiples eventually drop as inflation rises.
Mm.
And so that's another knock that says stocks aren't always a good inflation hedge. So, Fritz, I would be the first one to say that throughout history, stock market bubbles can last far longer than logic or fundamentals would suggest. So we can't rule out a continued rebound here. But so far this year, I would say that every rebound we've had has had the profile of a bear market rally because you get that sense of relief, that sense of hope that the correction's over. It draws more money into the market, but it peaks before it gets up to the level of the previous high, and then it falls below the level of the previous low. And that's very much the profile of a bear market rally. So far, I think that's still intact.
Great. All right. So we have the bond market under pressure. So as you just iterated actually very nicely, this is therefore a difficult time if you have a 60-40 portfolio, right? You have 60% in stocks, you have 40% in bonds. Your bonds are not holding up. So my final question, as usual, is how then should investors consider positioning their portfolios in the current environment?
Well, I think you're right to point out with the 60-40 portfolio, which has worked well when we had an environment of falling inflation, falling interest rates, because what happens is when the stocks don't do as well, the bonds do well. When the bonds don't do as well, the stocks do well. They counteract each other. Well, that's all by the wayside. We've had a regime shift where no longer are interest rates, inflation falling. Now they're rising. In a
Mm.
regime shift, stocks and bonds can both move in the same direction. And this year, they're both moving down. So there's no hedging going on between the two. So what do you do? So in an environment of rising inflation and interest rates, traditional bonds are the least effective way to hedge against or to complement the stock portfolio. And really what's required is a highly diversified multi-asset portfolio that includes hedges such as real assets like gold,
Mhm.
commodities, floating rate treasuries, which have no duration risk, which just make money as interest rates go up. And then TIPS or Treasury inflation protected securities, where the principal value of the tip rises at the rate of CPI, which the last reading was 7.9%. That's a good deal. So these have all fared to be much better hedges than nominal bonds during inflationary environments historically. Also, on the equity side, relatively undervalued dividend oriented stocks typically have performed better than more speculative growth stocks in an inflationary environment. So, with a multi asset portfolio, it's actually possible to make money and generate positive returns in an inflationary environment when more traditional stock and bond portfolios might be losing money at the same time.
Great, thank you. Very, very helpful in an environment that I think is confusing for all of us. So I think it's I think you set us straight there and gave us a pretty good understanding about exactly where we are now. So it'll be very interesting as we proceed through the rest of 2022. But so thank you very much for that, and that will do it for Steve and me. Remember, all our videos are available on our Three Edge YouTube channel. And in addition, all our videos and our written commentaries are always available on our website at 3edgeam.com. So until next time, on behalf of Steve and everyone here at 3 Edge, thanks for listening.